Hey guys, it's Jack. Today we're going to be looking at the top 5 ISA mistakes you need to avoid so you don't end up losing money. Now these are the mistakes I've seen that are not only common amongst beginners but even those who are familiar with investing. Investment rules around the ISA change from time to time, so if you're in a set it and forget it mentality, you can certainly end up letting certain things slip. Now before I go any further with this video, I'm going to say that this is not financial advice, this is simply my opinion. If you don't know what a stocks and shares ISA is, then we do need to have a little bit of a recap so you can fully grasp the points I'm going to be mentioning next. A stocks and shares ISA is a government wrapper which allows you to invest and gain appreciation and income from your investments tax-free. It's currently the limit of what a single person can end up investing in a single financial year is £20,000 inside of an ISA, which means you cannot invest more than 20k in a single year without losing the tax-free status. Now the very first thing people do look over is when they're picking their funds. Let's take the popular S&P 500 index fund for example. Now on freetrade, this fund comes in two forms, the VUSA and the VUAG. The only difference between these two funds is that one is a distribution fund and the other is an accumulation fund. A distribution ETF will give you a dividend payout directly to your investment account. An accumulation fund will in fact not give this payout to you and reinvest it, acquiring more shares in that particular ETF. What happens is that if you're investing in the VUSA, which is the distribution fund, the money will come to your investment account, it will sit there until you actually go out and reinvest it back in the fund. Now this might not be a big deal to you. You might be thinking, I can go onto my investment app every quarter at least and reinvest that dividend amount, which is fair enough. But if your dividend payout is below the share price of the ETF, now that money is just sitting there for longer or until you gain enough money so you can actually go buy the ETF again. For example, if your payout is £10 every quarter, you would have to wait at least a year for you to go out and actually reinvest that money back into the S&P 500 ETF because it's currently at £53, which means that all this time your money just sitting there not being put to work in a glorified savings account. Now the second mistake really comes when you're using a platform for a very long time and another investment platform just enters the market and you're really wanting to switch to it. It either has lower fees that has you attracted or better features. I've definitely seen this occurring when a lot of people have switched from the sort of old age investment apps like HL into the newer ones like Trading 212 and freetrade. Now the problem comes when you're using the wrong process to move the funds from the old investment ISA to the new one. You can theoretically just sell all the stocks in your old portfolio, withdraw, use the same money to buy the very same stocks in your new platform. Although this makes sense thinking about it, this method will destroy your tax-free allowance. In the eyes of the government, you've just opened a new ISA and you've just begun investing into it. They're not going to be accounting for the fact that these gains were from a previous ISA. Moreover, if you have been investing for a number of years and you have more than the 20k a year limit and you do this method, you can potentially end up paying more tax because you'll be over the yearly limit of £20,000. So the golden rule for moving funds from one ISA to another is completing an ISA transfer form. This is the legitimate process in which you don't actually end up using your ISA allowance and you let HL, Vanguard and whatever platform you're choosing do all the work. You won't mess up your tax-free allowance for this method and it'll save you a lot of hassle with HMRC. But what you must do is check whether the new investment ISA does offer the same stocks and shares as the old one, as not all platforms are created equally. Now before I move on to the next reason, which I believe has just been brushed up quite easily by a lot of people, do make sure to like and subscribe if you're learning something new so far. Now the third mistake that people does seem to overlook is fees. A 1% fee may not seem like a lot for a financially successful future, whatever that is, but a 1% fee is still way too much. For example, the difference between a 0.6% fee and a 1% fee can mean a potential loss of £16,000 in potential gains you would have got if you opted for the lower fee version. And honestly guys, there's too many platforms that just charge way too much. Now you see this a lot with robo investment apps like Money Farm, which charges a staggering nearly 1% annual fee according to their very own website. Although yes, you won't get their funds on another platform, if you do some digging on YouTube and you spend some time researching, you can easily find a way to replicate the same funds and give you the same exposure for a much cheaper price. One thing for sure, guys, is that you cannot control the stock market, but what you can control is the fees and the platforms you're going to choose. Making these choices well can have a positive impact to your investment gains in the long term. Another mistake people seem to make is around diversification. Now, there's two sides to this story. First things first is that if you've seen a lot of people make a lot of money investing in individual stocks rather than ETFs and index funds, then it's likely because of the larger bull run we've been seeing. The market has just been going up apart from a small blip we saw in March 2020. What you absolutely cannot overlook is the returns in a bear market, in a market downturn. Just investing in a few stocks in one particular sector will not give you the diversification and the protection you need. Now, we've seen this recently with the tech sell-off. Diversification is absolutely key, and the best way to get diversification is by investing in an S&P 500 ETF or even an all-world ETF for global exposure. I myself have 80% of my investments in the S&P 500 and only spend around 20% on other types of investments. Obviously, your allocation will depend on your investment goals and your time horizon. The key thing here is to keep it simple. Do not go about researching and investing in hundreds of different stocks. You won't be able to keep track of them all. This may in turn reduce the benefits of diversification as you let bad companies sit in your portfolio for an extended period of time, because you haven't realized that they're bad. By investing in hundreds of companies and not having the time to manage them all, you might in turn ruin the benefits of diversification, as you might let a certain company sit in your portfolio for a long period of time that may not be doing as well. Now, another thing you must not do is follow YouTubers like me blindly. Do your own due diligence. Seriously, some YouTubers get paid thousands upon thousands to promote stocks as part of a wider pump and dump scheme. Now, these are normally very low cap penny stocks which are easy to move in terms of their price. What certain people do is that they buy a ton of shares in such penny stocks. Then they reach out to these YouTubers and offer them payments between 5, 10, even £20,000 to promote certain penny stocks as part of a pump and dump scheme. The finance YouTubers would then exaggerate the potential of such penny stocks and mislead their audience. The funny thing is that because of the pump and dump scheme, a lot of them will be contacted at the same time. So you'll see a lot of videos at the same time on a stock you've just never heard of before. After they pumped up their shares to their audience and the audience members have then bought it, the pump and dump scheme masters will just sell off their shares at a premium and the audience members will be at a loss. Even me having a small channel hasn't stopped these middlemen companies contacting me, asking me if I want to be a part of their pump and dump scheme. And now obviously I've never done this and I never will because I have integrity. You should definitely really research the things you're investing in and don't follow someone because they have X amount of subscribers. I know it's easy to forget, but subscribers do not mean anything. There's plenty of large finance YouTubers who have lost millions publicly, especially in the American space. So please don't waste your time, money and your ISA allowance on such nonsense. If you found this information useful, please make sure to drop a like and subscribe if you want more videos like this, and I'll see you in the next video. Thank you so much for watching.